to supposedly normalize their balance sheet. And if you look at the balance sheet, it barely budged really between COVID and the present conditions. When the government is trying to control everything, it doesn't know anything because it doesn't know the real price of anything. And one of the consequences of that, of course, is that, whoops, the price of gold and silver have exploded. Are they going to destroy this country? Because that's what they're working on right now, is destroying this country. Or are we really interested in rebuilding this country? And it's also the engine or the seedbed of corporations that become larger. So anybody who tells you that we're going to solve this problem as a top-down approach is selling you a bill of goods. It's structured as if it's independent, but it's really a political animal. And so we have to unlearn much of what we're told on the mainstream media about Fed independence, about the Fed balancing its dual mandate. As far as I can see, the dual mandate is not about balancing unemployment and inflation, but it's about serving the interest of Wall Street on the one hand and of Washington, D.C.'s profligate spending on the other hand. And if you make that switch in your mind away from this public interested balancing act that they constantly talk about and refrain on and make excuses about, and learn the real long run truth of where the Fed came from, why it's there in the first place, and what it's designed to do from the get-go, back in the early days of the Fed, then you realize that it's there to bail out Wall Street on the one hand and to enhance its business in the short run, and then to serve the federal government and its borrowing, and of course bailing out the U.S. Treasury whenever necessary. Then you can really understand what it's doing today. That whole thing about data dependency is really funny now in light of the fact that they continued to behave exactly the way they were when the data disappeared with the government shutdown. So, if we remember back to the fall and Powell, hanging tough, refusing to cut interest rates, and so forth, and remaining strong. Of course, he was worried about the value of the U.S. dollar at the time. And then at Jackson Hole, they came out of the mysterious Jackson Hole, Wyoming meeting, and all of a sudden the Fed had seen the light, and they were worried about labor market conditions and so forth. And they basically had a kumbaya moment where they said, we need to really think about loosening up on interest rates and opening the spigots of the money supply. And, that's what we've seen ever since. It appears on the 6 o'clock news as if there's still this ongoing battle between the president and the Federal Reserve. But actually, that was over with back in the fall when the Fed decided, well, we're no longer going to be doing quantitative tightening. We're going to cut back on that. And then, of course, they cut that off entirely so that they were no longer, sopping up and reducing their holdings on their balance sheet. So they stopped all that. And then they said, well, we need to inject another $40 billion each month into the marketplace for liquidity concerns. Of course, it doesn't matter really what you call the reason. They're injecting $40 billion of new money into the market now. And of course, they're cutting interest rates. They're signaling more cuts in interest rates. And, so it's unclear whether when President Trump appoints a new chairman, this, coming up pretty quickly, and additional members, that the Fed was already pretty dovish to begin with, and has become much more dovish just in the last year in terms of the new members that are on the committee and the old members that have left the committee. And of course, President Trump is, going after Federal Reserve board member and Chairman Powell and the Fed itself with criminal charges or indictments right now.
Right.
So, I mean, it's a full court press, but the Fed is already, pre-committed to a loose monetary policy. They're concerned about a variety of things, the value of the U.S. dollar, and in particular, everybody's talking about cutting interest rates. But the Fed really controls directly the short-term rates, but they're really concerned about the long run 30-year U.S. government bond, the 10-year U.S. bond, because those have been threatening to move higher, and those bond prices to move lower, and that's really a critical aspect of the whole overall financial market, and that's true not just in the United States, but it's true around the world.
Quantitative tightening, the Fed's strategy for shrinking crisis-era balance sheets, quietly faded before it truly began. Instead of allowing higher interest rates and reduced asset holdings, measures were dialed back by market pressures and political calculation. Today, the bond market, a cornerstone of global finance, conveys stress through its pricing signals. Yield distortions, widening credit spreads, and central bank intervention reflect the fragility beneath the surface of economic calm. Investors and policymakers alike are starting to view bonds not as stable ground, but as the early warning system for the next crisis.
I think we need to go back to the 2008 crisis when they started the quantitative easing programs under then Chairman Ben Bernanke, and they were buying up all these government bonds. They were buying up all these 30-year mortgages, adding them onto the balance sheet and injecting money into Wall Street. And Ben Bernanke said, well, we'll just sell that all back into the market whenever we get around to it. And of course, they started, at some point, they started tightening, and they started tightening just a little bit. And then, of course, in 2018 and 19, those small sales of the Fed back into the marketplace started to create cracks in Wall Street and that fragile financial fabric that the Fed system created. And then we had the COVID emergency.
Shocking.
And trillions of dollars of new money, of new government spending, and they had basically the quantitative tightening was a very small percentage of what they had injected back in 2008 and 2009, and then they just doubled and tripled and quadrupled down during COVID. And then they said, well, we'll just, sell these assets off gradually and nobody will know the difference. But it's, they had years to supposedly normalize their balance sheet. And if you look at the balance sheet, it's barely budged really between COVID and the present conditions. And then all of a sudden, late last year, they said, well, we have to stop this process because of liquidity concerns. And in fact, we're going to have to start this new program of new injections into the economy to stabilize liquidity and that sort of thing in the marketplace. So what is, and the Austrian economists Mises and Hayek and Rothbard have been trying to teach us all about this for a very long time, including going off the gold standard in 1971, that temporary government programs are almost automatically going to be permanent programs until the American people and people more generally stand up to Washington, D.C. and the political establishments and the political elites and say enough is enough. And, and the going off the gold standard and these temporary policies by the Federal Reserve are just another reminder that politicians will continually try to hoodwink the American economy, saying that they're doing it in the public interest and in the interest of the average American, but really they're just doing it in their own personal interest,
right?
And the interest of the people who supported them and got them into positions of political power in the first place.
The pandemic unleashed unprecedented monetary stimulus as lawmakers and central bankers sought to protect economies. The result? An explosion of public debt that, once thought temporary, may have permanently altered how modern money functions. Massive liquidity injections did little to solve structural issues and instead entrenched dependence on perpetual borrowing. Now, with central banks hesitant to tighten meaningfully, the axis of economic debate has shifted. Can debt-driven growth be unwound without triggering recession or financial instability?
The problem in Japan goes back many, many years into the 1980s, when they thought that they had learned this Keynesian magic of just printing money and suppressing interest rates and the government injecting spending into the economy. And they've done that on a massive, massive scale. Inflating their currency. Their national debt is the worst in the world at over 225% of their gross domestic product. And of course, once you get to about 80%, history says that it's almost irreversible that you are going to crash your economy. You're going to doom your economy. But the Japanese have stuck with this failed Keynesian policy program of just spending as much as money as possible and of borrowing as much as money as possible and of their central bank monetizing the debt by purchasing the government debt. And of course, the Japanese, your audience has heard of the yen carry trade, and what that was all about was suppressing the value of the Japanese yen, its currency, and keeping interest rates down close to zero or even negative in some regards. And this was an engine really of worldwide inflation, and it helped really inflate the government bond bubble by allowing people to borrow money in Japan based on those ultra low interest rates and then reinvest the money, sometimes in multiple leveraged forms, in other government securities, the U.S. the U.S. government debt and other government debts around the world. And so the Japanese were really one of the big sources of the worldwide government debt bubble that we're now facing right now. But of course, Japan has reversed itself. I'm not sure exactly the mechanism there, but I think they're kind of forced in order to protect the Japanese currency from running away, spiraling downward in value. They've allowed interest rates on Japanese bonds, government bonds, to increase. And so right now we're seeing, the Japanese government bonds, the interest rates on those longer term government bonds look like, well, they're almost normal compared to other countries around the world. So that's a big concern, I think, for central bankers who see that as a big tangible change in world financing, and they don't know what to think of that. And the problem is, of course, is that central banks, particularly the Fed, has tried to grab a hold and control of every aspect of financing in the U.S. economy and therefore the world economy. And the problem with that, instead of a central bank just trying to control one thing like short-term interest rates on Wall Street, Now the Fed is trying to control everything. And just like in socialism, when the government is trying to control everything, it doesn't know anything because it doesn't know the real price of anything. And one of the consequences of that, of course, is that, whoops, the price of gold and silver have exploded.
Japan's long-running sovereign debt dilemma, with debt more than double its GDP, has repeatedly been spotlighted as a harbinger of similar stresses elsewhere. When a major economy carries such an outsized debt load, the ripple effects extend beyond its borders, influencing global interest rates and investor confidence. As governments struggle to balance services, growth, and fiscal responsibility, the Japanese experience stands as a cautionary tale. High debt isn't just a number, it's a systemic pressure point with real implications for currency stability and long-term growth.
This is the perennial question, and the kicking the can down the road policy, which is kind of a stupid way of doing things, right? Nobody believes that, just kicking the can down the road is going to be the right policy. It's irrational.
Yes, it is.
But it is precisely the policy that the political elites want us to follow. They want us to follow a policy where we continue to add and continue to borrow, with the federal government continuing to borrow and adding to the national debt, and the Fed continuing to print, maybe in a more balanced way, but they want that, continuation policy because they're the ones that are making all of the money off of the government bonds and the issuing and the selling of government bonds. They're the ones that are making all the money off of the lucrative government contracts, for spy software and government military contracts and, all of the rest. They're the ones that are benefiting from that. So they want it to continue, even if it's in some kind of amended form. And what the average person, the average household, the average small business person, the young people coming up and, are trying to educate themselves, and they're looking forward to starting families and households, that really calls for wiping the slate clean, radical reform, getting the monetary system fixed now, maybe taking our lumps now, but getting it fixed so that interest rates become more rational, the money becomes stable, its purchasing power is relatively fixed. Even it might even actually be appreciating, which is even better in terms of stimulating savings. Of course, the Keynesians and the government have always been against savings, but, personal development and household formation and family, continuations, that all depends really on a process of working and saving and becoming wealthier and having a higher standard of living, starting a small business. That's where all of that comes from, and that's why the Keynesians and the government have always worked against savings. I mean, they devaluate the money, they tax interest, and they make personal savings almost impossible to do in the current environment. And then, of course, they're giving tax breaks if you borrow money, and so it's not surprising that we've ended up in a population that spends everything it gets and adds its credit card balance. It maxes out their credit card balances. That's the situation we're in right now. I'm arguing for a completely different system that discourages all that and encourages the exact opposite of that kind of thing. So I think if we have a radical reform, and get a sound, stable monetary system, and we get government out of the business of money and all of these other related issues, that's really what's good for the next generation as well as this generation. And I think, that's what people my age should be thinking about, not their own personal standing in this whole thing, but what they're going to be doing for coming subsequent generations of Americans. Are they going to destroy this country? because that's what they're working on right now, is destroying this country, or are we really interested in rebuilding this country? And rebuilding this country never starts at the top. Nothing good ever starts at the top. Everything, we know this intuitively, everything that's good starts from the ground up.
Yep.
It starts from the bottom up. That means people, individuals, families, households, small businesses. Small businesses, the engine of economic growth and development and new jobs. And it's also the engine of, or the seedbed of, corporations that become larger. So anybody who tells you that we're going to solve this problem as a top-down approach is selling you a bill of goods.
Gold and silver have long been barometers of economic anxiety, but recent volatility has challenged old assumptions about safe assets. Price swings in precious metals reflect deeper questions about the strength of fiat currencies like the US dollar, especially as debt levels rise and central bank credibility is tested. In an era of digital assets, geopolitical uncertainty, and unconventional monetary policy, the role of tangible wealth stores is under intense scrutiny from investors seeking refuge from inflation, currency devaluation, and financial disruption.
Kind of hobby of mine, but it's also, what I do professionally is, the mission of the Mises Institute is to try to improve our understanding of free markets and sound money, and to teach people how they work in the real world. But, you have to admit the fact that people have little to no idea of what free markets are, what they really are, or what sound money really is. Now, as discouraging as that is, I must say that I'm very optimistic about the future, in the sense that people are becoming disgruntled about the current system, and they're much more open-minded now than they were just a few years ago.
Yes.
And they're really really trying to work out in their own minds these conundrums about why Americans are at each other's throat, about why the stock market is doing so great, and yet people around the neighborhood are doing so poorly.
Yeah.
And so I think that really makes our efforts continually more and more important. But the reason I'm optimistic is because people are increasingly more open-minded to these new ideas, and they're increasingly not trusting their overlords in Washington, D.C., and they're suspicious of the political elites that ultimately control, these small number of corporations and these political parties and the media. So, moving forward, I think we have a huge job to do, but the fact that there's a receptive audience out there really energizes me about the future.
As public and private debt has ballooned worldwide, market observers now confront fundamental questions. What happens if confidence erodes, and how do retirement funds, bonds, and currencies respond? The traditional remedies, printing money, cutting rates, and expanding credit, are showing diminishing returns. Institutions are exploring new frameworks while everyday investors watch markets with heightened vigilance. Whether through policy innovation or systemic reset, the coming years may force a reassessment of how modern economies sustain growth, manage risk, and distribute financial power.